Hello. How's it going?
Oh, good. I just came back from that trip to Asia and, getting adjusted. I woke up the first night at 3 a.m, couldn't go to sleep.
Ugh.
Last night I woke up like 3 times.
Ugh.
And then I didn't wake up this morning until 8:30.
Oh my gosh.
Oh my gosh. The work day's already started. What am I doing? It's crazy.
Slacker. How dare
really
you?
Bad. It's been really bad. Yeah.
And now we're just going to jump right into the holidays.
Yeah, here we are.
It's like
you came right back and you're into, holiday. Happy holiday. What's going on with you with the holidays?
So we do the Italian Christmas Eve. It's all about Christmas Eve in our family. Like, we don't even do Christmas. Santa comes and that's it. So cousins, and we hand roll pasta. It's usually like a spaghetti and a gnocchi of some kind.
Ooh.
I like to do a sweet potato gnocchi with this sage. It's like a brown butter sauce with maple syrup in it, and then you fry some sage in that, and you just pour it. This is not healthy, but it's so delicious. That's mine.
Who thinks about health during the holidays? It's about just gorging yourself, right?
True. We'll worry about that in January.
Yeah, we'll worry about it then. Yeah.
What about you?
We have this is the year we have all of our kids, because they kind of go to the in-laws and back and forth. This is our year to have them. So we're excited. They're all going to be here. House is going to be vibrating. The walls are going to be bending.
Is everyone staying?
Yeah. They're
5 kids plus spouses for a lot of them.
And grandkids.
Yep.
It's going to be a crazy,
How many
crazy
grandkids
time.
you have to?
We have 5 and 1 more on the way.
Oh my
gosh.
It's exciting. So exciting. And today is the first day of Hanukkah. Happy Hanukkah to everyone that celebrates that. I think this year is probably not a happy Hanukkah for people of Jewish heritage. And so we just send our love and our light to you. And we hope that you can find some peace during this season.
Indeed.
Good time with friends.
I was going to just tell you a funny story about Christmas, for, in our family. Mark, my oldest son, Mark, and I, he buys incredible presents for all of our kids. I don't know. He does it. My wife and my daughters are like, "Oh, Mark." It's like they just gush when he gives them stuff. And I get like really frustrated, because he's so good at it. And then I buy something like, "Oh, thanks, Dad." And like, okay,
you don't get to win the big.
So he always outdoes me, not meaning to. It's not even a competition for him, but for me, it's become a competition, right?
Does he know you're using competition?
He kind of does now. It's like, I got to beat him.
Yeah.
And so, what I did was I got so competitive that one year I thought I was going to beat him, and I got this little decibel meter on my phone, and I turned it on and I registered when they opened his present. And then when they opened my present, and I really wanted to have the decibels higher.
Stop it.
When they opened mine. And
oh my God,
I can't remember if they did or not, but my family thought I was absolutely insane that I'd lost it. And I thought, you're right. This is.
Do they now make a big deal for you?
No,
just cause?
No, they don't. It's good.
Come on, Delmonte, just give him a
no. It's
the
fine.
guy needs it.
It's fine. I realized the folly of my way. I was like, come on, get over it. He's a better present giver than me.
I don't know. Whatever. I mean, I have to say the best part of Christmas is when I make my mom cry. Like every year, that one sentimental gift that gets her crying. Like that's our goal. Make mom cry on Christmas.
Oh, that's
every
really
year.
Cool.
Mom, I'm failing you this year. I don't have it yet, but I'll figure it out.
Well, welcome to A Place of Possibility. I'm Richard Delmonte.
And I'm Angela Wright.
And we're happy to have you here with us on this special year-end tax and financial planning podcast.
Yes. So we are here to tell you all of the little tasks and strategies that you need to employ before December 31st. It is the 7th, I think. So you don't have very much time.
3 weeks.
But we're going to give you the list.
Yep.
And we really, these to save your taxes, increase your savings, keep you on track for your financial goals.
Right. This might be a little longer show today because we got a lot to cover.
There's a lot that you should be doing.
A lot to cover. Yeah. Okay. So let's create a foundation first for the pointers we're going to give you. First of all, one of the biggest areas we always like to address is tax when it comes to, the end of the year work. So we're starting there. Basically, we look for opportunities to do what we call tax arbitrage. And so that means either recognizing taxable income today, this year, to be able to pay the tax you owe on that income this year, or in the alternative, deferring the income until next year so you can pay tax then. Why do we care? Well, a lot of times your marginal tax bracket is going to be significantly different this year versus next year. So if your tax bracket this year is lower, you would actually want to accelerate or bring income into this year. I know it sounds like heresy, right? Because you're going to pay a lower tax on it. Yeah. On the other hand, if you're going to have a lower tax rate next year, or the rates are even, you would want to push income to next year.
Yep.
So that's what we're trying to do. It's kind
a
of
lot of
underlying
these tips
everything.
are around
Yeah,
tax arbitrage,
right,
actually. So
right.
you learned a new word, tax
Yeah,
arbitrage.
arbitrage. Yeah, like jujitsu. Boom, boom. Yeah, it's good.
All right. So all kinds of nuances here. We're going to dive in with, I think, one of the most important ones for our older population, and that is required minimum distributions. The penalties for missing these are steep. So if you are 73 or older, you must take a required minimum distribution by December 31st for any retirement accounts that you have. So that's 401k, IRA, SEP, IRA, 403b. There's more, but
a few more letters. And
I won't list them. But
Yeah.
anyway, you need to take that by December 31st. The penalty for not taking it is up to 25% of the amount you were supposed to take. And then you have to pay the tax on that amount. So it's a really bad idea to miss this. If you turned 73 this year, you technically have until April 15th of next year to take your required minimum distribution. So this is a tax arbitrage opportunity, right? If you think that your income is going to be much, much lower in 2024, you might actually wait and take that RMD in 2024 because you only get that special circumstance your first year. Every subsequent year, you have to take your RMD in the calendar year. So if you wait in your first year, you have to take 2 the next year. So you would only do this if you knew your taxable income was going to be lower in 2024 than it is today, right?
Yep.
Most of the time, people take the RMD in the first year. It makes sense to spread it out for folks.
Right.
What else do we want to say about RMDs? If you received an inherited retirement account, inherited IRA, for example, if you inherited that account prior to January of 2020, you have to take a required minimum distribution. This calculation is really complicated.
Yeah.
So I urge you, implore you actually to talk to an advisor or CPA before you do it.
Yep.
If you inherited after January 1st, 2020, you just have 10 years to drain that account however you want. That is a huge planning opportunity.
Yep.
You really should sit down and think about the next 10 years and what's going to happen. It may make sense to spread it out, or maybe you do it all 1 year, depending on the size of the IRA. Who knows? If you are still working and you don't own more than 5% of that company, you don't have to take a required minimum distribution if you're over.
Lucky you.
Yes. Okay. I think that's it for RMDs. What's next?
Okay. Next, if you are age 70 and a half and older, you can actually take withdrawals from your IRA and give them directly to charities in the form of a charitable contribution. These are known as qualified charitable contributions, or QCDs. And they are not taxable to you as the owner when you take money out of your IRA in that case. On the other hand, they're not deductible to you as a charitable contribution either. So you can contribute up to $100,000 per year using a QCD. And then why would you want to do this? Why would you want to not get the deduction, right? You think, well, what's happening is when you make a contribution to a charity, it's an itemized deduction. You can write it off against your income tax in a way like it's on your itemized deduction list, Schedule A. And so the problem is everybody gets, like, if you're a married couple and you're over 65, you get $30,700 already as a standard deduction that you're going to get. So you have to be able to exceed that before you even get $1 of deduction. Yeah. Many people, if they don't have a mortgage and stuff and they're older, they're not there.
With the 10K cap on state tax.
Yeah.
Most people aren't getting there anymore.
Right. So they're not gonna exceed $30,700. So they might make a contribution, they get no benefit tax wise. Yep. So that's why in that way you can use the QCD. You can take the money out of your IRA, not pay tax on it. And it works the same, really. I mean, normally if you take money out of an IRA, it's taxable. Then you make the contribution, it's deductible. The net is a zero wash if you're lucky. This is an automatic wash. Yep. And there's no, consideration about the itemized deduction limits or anything. Yes. So it's a better mousetrap, really, for many, many people.
Agreed. And if you're over 73 and you're forced to take RMD and you don't need the money, a lot of people will take it, transfer it into their brokerage account and reinvest it. Consider donating it to a charity. And then you don't realize any of that income.
Right. And another little pro tip is if you were going to pay tax on your RMD anyway, right? So let's say you're going to take $30,000 out as an RMD and it was going to be taxable. You could actually give that $30,000 to your favorite charity. If you're already charitably inclined, you may be doing it anyway. And then now your tax is zero, right? So you could, to be able to get back to where you were before, you were going to have $30,000 taxable with the IRA distribution, RMD. you could take the money out and do a Roth conversion.
Yeah.
And you're in the same position you would have been in before.
Yep.
And it kind of works out that the Roth conversion is not taxable that way.
Yeah.
In a backhanded way.
Sort of, because you're going to pay the tax anyway. Right. You're the same.
So QCDs are a really good thing. Why is it 70 and a half instead of 73? You brought this up earlier when we were talking about it.
Yeah, because 73 is the RMD age, 70 and a half used to be, and then that was when QCD started.
Yeah.
And did they change that?
Yeah, they changed the rules for RMDs, but they didn't advance it for QCD.
Which
Luckily,
is for the best for us.
Yeah, they really should let more people do this.
Yeah,
agree. Yeah, for sure. Yeah,
agree. Okay. So next, harvesting tax losses. That is when you have a stock or a mutual fund, ETF, bond that has a loss, you sell it, and now you have a capital loss to report on your tax return. You can write off your capital losses up to the amount of capital gains you have in any one year, or you can write off $3,000 a year against your ordinary income and get a little reduction of your income. And you can carry that. It's called a carry forward. You can do that forever, as long as you have these losses. And so let's say you have Target stock in your trust account that you bought, a couple of years ago. Now it's down. So you sell. Here's how this works, right? You sell that Target stock at a loss. Now, an important thing to do is wait 30 days before you buy it back. Otherwise, it's called the wash sale rule. The IRS is on to us. So you have to wait 30 days. Hopefully nothing weird happens with Target stock, or you could do another retailer in the meantime if you don't want to be out of the market. Then you purchase back the Target stock. Maybe it dropped more and you got a better price.
Hopefully.
and now you've secured that loss, but you're still in the market and you still own the stock. So if you want the write-off for 2023, you got to sell the stock and harvest the loss in 2023. And you could be doing this all year long. When you see a loss, you take it and you put it on the books for yourself.
Always. Because even a $3,000 loss against your ordinary income, that's $1,000 of tax savings for most people.
Yeah.
So it's worth it to do it.
Yeah.
Yeah. It's like putting money in the bank, a tax bank, and you're going to get it at some point.
So I will say, I'll add a layer of sophistication to this, because there are some people who are kind of ringing an alarm bell on tax loss harvesting and saying, hold on, wait, don't do this. If you think your taxable income is going to be much higher or lower in like a big change one way or the other in the future, you might want to reconsider, because essentially what you're doing is locking in a lower basis on the position. And
true.
So, there could be problems with it down the road. Yeah. But for most people, it makes sense to just do it and get the write-off.
I wouldn't worry about that. All right. Okay. So the next one is making contributions for this year to your IRA, SEP IRA, or your 401k, 403b, whatever. So for 403b and 401k specifically, and if you're an employee, those contributions have to be made this year. So with maybe 1 or 2 paychecks left, you'd have to basically go make all your income and go into the 401k to max that out. You can still do it. It's worth it, especially if you need to get your tax rate lower.
Yeah. It's really 22,500 if you are under 50. And so like a cool planning tip for people is if you get a holiday or a winter bonus, that might be a good opportunity to just dump a large chunk of it in the 401k. Not only would you reduce your taxable income, because bonuses are taxed so high, but you're getting up, to the max. Maybe you're even getting more match if your employer is matching that much. So if you can afford it, try it, because I'll tell you one thing, if that bonus hits your bank account, it's probably not going back into savings. So just skirt your own self and stick it right in the 401k.
Yep, for sure. Wise.
Yeah. So speaking of 401ks, you could and should, if you have more money to contribute to yours, ask your employer if your plan allows for a mega backdoor Roth option. And if they look at you like, huh?
Yeah.
Then you can ask
probably.
for, can I make non-deductible contributions up to the max? The max is as high as $68,000 in 2023. So that incorporates your employee deferral up to $22,500 if you're under 50, your match, and then you have all that room up to $68,000 to make non-deductible contributions to the 401k. So most of us are getting about $30,000 a year between our own deferrals and our employer's match. That's an additional $38,000 a year that you're putting into your 401k. It's non-deductible. Why would we do this, Richard?
Because you're going to get tax-free income on that Roth for the rest of your life.
It's a Roth.
Yeah.
You're putting $38,000 a year into a Roth.
Yeah. Instead of $7,000 or $6,500 or
you should also do that because
amount.
you could do your backdoor Roth for the $6,500 and then you can do this.
Right.
And oh my gosh, if you do the math on this, you could be pulling multiple millions of dollars out of a Roth IRA at retirement, tax free.
Yeah, it's a way to go. You have to be careful, and not everybody can do it. Not every
plan allows
limits and things like that
for it, right? If you're the owner or highly compensated, you might cause problems in your safe harbor calcs. It's complicated, but for $38,000 potentially of tax-free income, it's worth a little bit of effort. Like at least send the email to HR.
Try it. Just try it. Yeah, most people that we see benefiting from it are places where there's a lot of high income earners, tech. Medical, professionals,
medical
things like
practices
that.
can do it usually.
Yeah. Okay. All right. Next, we're going to talk about health savings accounts, HSAs. If you have what's called a high deductible health plan, you are able to put money into a health savings account, and it's tax deductible for you. And when you take the money out to pay for your medical expenses in the future, anytime down the road for the rest of your life, it is tax-free. One of the only, in fact, I think it's the only benefit that goes tax-free going in and tax-free coming out.
Deductible going in, tax-free going out.
It's
the
amazing.
Only thing.
Plus the growth on it that you earn while it's invested in there, tax-free. Mm-hmm. So it's like a Roth on steroids.
Kind of, yeah.
Yeah. So the limits are for a married couple, you can put as much as $9,750 in for 2023. If you're over age 55 and you both are covered under an HDHP, which is the kind of health plan that we talked about. And the qualifications are you have to have an annual deductible that is not less than $1,500 on a single coverage person plan, or $3,000 for family coverage on your health plan, and for which the annual out-of-pocket maximum is not less than $7,500 for self-employed or $15,000 for a family.
Yep.
Yeah.
So this is interesting because some people have a high deductible health plan per this IRS definition, but their plan doesn't say HDHP and their company doesn't offer an HSA. If that's you, and your family coverage deductible is $3,000 and your out of pocket is $15,000, you can just go set up an HSA account. Fidelity, Lively.com, Schwab's has a minimum of $3,000. So I highly encourage you to talk to your accountant before you do this. There are a lot of them who would say, don't do that. You don't have the HSA through your work, so don't bother. And a lot of them would say, yeah, you meet the definition. I'm okay with this. So be careful, but please look into this if this is you, because this is massive.
This is actually one that you can do. Can you do it until the tax date? You can do it till April 15th.
I think so.
Yeah, for this year.
We'll put it in the guide.
Yeah.
So if you are self-employed, this one's kind of a duh, but I feel like we need to say it. And you need to buy something for your business, do it this month. Like, don't push that expense off. Forward as many expenses as you can, because I'll tell you, as a business owner all these years now, something always comes up. There will always be another expense for next year. So just do it. Forward the expenses. It's totally worth it.
I have found myself many times on December 31st, like, there's a bunch of money in the checking account for business. Let's just pay off a bunch of things in advance.
I don't take December 31st off anymore because there's always a purchasing extravaganza. There is. And whatever last minute client thing that needed to happen. One of you is going to call me on December 31st about this stuff. So, pro tip, if you need a vehicle, this is pretty cool.
For business.
Yes. Yeah. We're talking to self-employed people now. If you buy a vehicle that weighs more than 6,000 pounds, for the business, you can expense almost the entire thing in 2023 instead of depreciating it. That could be massive. If you're having a banner year and you need a vehicle, go get yourself a 6,000 pound one.
Yeah. So those are usually like, a big Sequoia or a Tahoe or a Suburban truck, big work truck. Those things, they're all 6,000 pounds. Yeah. I think it was 2 years ago, I went out on 12/30 and December 30th, bought a Tahoe, and I was able to write off $75,000 that year on my taxes. I think you said it was, you were mad at me because
I was. This is the year that I paid more dollars in taxes, and I'm pretty sure our AGIs were like, you had quadruple mine. But so listen up. He paid less dollars in taxes than someone who had like a quarter of his income because of he doing these sorts of things.
Right.
It makes a big difference.
Yeah, it's almost embarrassing. But
I was really
the tax code is set up honestly for people to be self-employed. They want you to own businesses because you hire people. Yeah,
that's a good point.
For sure. Yeah. All right. The next one is avoiding Irma. And this is not your old girlfriend. And it's not a disease. This
or
is
a hurricane. Was it Irma?
Or Hurricane Irma. Yeah. It stands for income related monthly adjustment amount, IRMAA. This relates to your Medicare premiums that you're going to pay when you're on Medicare. This is a basic inquiry that every Medicare beneficiary should be on top of before the end of the year. Mm-hmm. We find 1 out of 100 that actually have any clue that it's even a deal, and they don't know how to deal with it. Mm-hmm. So what happens is when your modified adjusted gross income, which we're going to call Maggie and Irma, exceeds certain thresholds during the year, your Medicare premiums will be increased 2 years later. So for example, if you are married and your Maggie, M-A-G-I, in 2022 was under $182,000, your Medicare premium next year in 2024 will be $174,070, $174.70. That's not quite there yet. Per month.
For me, that's how much it will cost
per month. But if your Maggie was $1 more, so $182,001, your premiums are going to rise by $82.80 per month per spouse. So that's almost $2,000. So $1 of extra income above the threshold, $2,000 of extra tax.
Irma's not our friend. We don't like her at all. She is the bad ex-girlfriend. Are we allowed to say that? I guess it's our show.
It's our show. We can
Explicit warning.
Yeah. But it's true. But wait, there's more, because there are 5 thresholds for Irma. And that's the higher your income is. And these premiums can go as high as $500 per month more per person, which is about $12,000 a year. So that's if you make like $750,000. Not everybody gets covered by that, but you got to be on top of this. This is something that's really, really important.
Yeah.
And so what can you do if your Irma income is above the Irma threshold by $1 or a small amount? Before the year is up, you got to figure out a way to reduce your Maggie, your modified adjusted gross income. As we were talking about recently, just in a few minutes ago, you can do things like realize a capital loss. You can contribute to your IRA or your 401k or your SEP. You can contribute to your health savings account. Interesting note, a tax deductible charitable contribution will not work, because that is, in the parlance of our world, below the line deduction.
So that's what the M stands. Everyone kind of knows what AGI is, adjusted gross income. MAGI stands for modified, and they're modifying it by taking some of these deductions away from you.
Right. So you don't get to use that until you're below the line. That's it, because it's an itemized deduction. So that's not going to help you. And again, if you're self-employed, go out and buy a Suburban or a Tahoe, and your Maggie will be.
You like Chevy? This is an advertisement for Chevy.
Year. Yeah.
Yeah. And so this is where, when we're like telling you these things, don't sleep on it. If $1. So let me tell you a story. I'm looking at a client's tax return, and they're doing over 70. They're making charitable contributions, but they're not deducting them. They were like $2,000 over the Irma. And I'm like, you're making these charitables, but you're not deducting them. And you're $2,000. This is costing you so much money. And so instead we started doing QCDs with this couple. $2,000 stinking dollars. And we saved them so much on their Medicare premiums. It's like, it's a no-brainer.
So you can't afford to just be ignorant about it. You should have a financial advisor that you rely on that helps you. The good ones do.
Yeah.
We're busy this month. That's what we're doing, is helping people make sure that everything is clean, and we're doing everything we can possibly do to help you.
Totally.
Yeah. Yep.
Okay. Speaking of, this is the one everyone will start calling on this one. We're going to talk about Roth IRAs, because there's a couple different things you can do. So the first one I'm going to go through is Roth conversions. Roth conversions. This is for people who have a very large IRA or 401k and very low income. So for whatever reason, maybe you retired, you rolled your 401k into an IRA, and now you've got, you built up a lot in your savings. So you're just kind of living off your savings before you start drawing on that IRA. You have no income this year.
Or low, yeah.
Low, right? Yeah. So it might make sense to take some of that IRA and convert it into Roth money. in years when your income is low, so is your tax rate, obviously. So it might be a scenario where your tax rate is only 10%. And I can take $30,000 from your IRA. You pay $3,000 in taxes on that today, convert it to Roth. Now it's going to grow. And you never pay a dime of taxes on that 30,000 or any of that growth later.
In the Roth.
In the Roth.
Right.
Conversely, if you had left it in the rollover IRA, when you go to pull that $30,000 out later, you could be paying 40% taxes on that, depending on your income and tax rate and the law that year. Who only knows what's going to happen? So you could pay $3,000 today in taxes, or you could pay $12,000 in taxes tomorrow when you pull the money out.
So this is an IQ test. What do you want to do?
You would be shocked the amount of CPAs that come back and say, why would you want to realize the income this year?
What's wrong with your advisor?
Yeah,
Why'd
we
they do that?
We had a CPA say that. Why did they convert this Roth and give you all this income? Well, lady, we did it because he's only going to pay $3,000 versus $12,000 later. This makes a lot of sense to us.
And they were like, oh, I get it. Okay.
So if you're in a low income, big IRA year, it might make sense to convert some Roth money. Switching gears, if you are high income, no IRAs sitting out there, you can do something called a backdoor Roth contribution, which is simply when you make a non-deductible IRA contribution. You can go up to $6,500, under $50,000, $7,000, over $50,000 this year. You put that in the contributory IRA, you don't deduct it, and then you immediately just transfer it over into a Roth IRA. And now you've completed a backdoor Roth contribution.
So good.
And you've got your $6,500 put away. You cannot have any IRAs, SEPs, et cetera, sitting out there. And this is for my folks who have high income. Like if you're married over 200,000, you can't go directly to a Roth. So you would be doing this backdoor style, essentially.
Right.
Let's see. What else do we want to say about Roths?
Well, so for people that have an IRA, and they're kind of precluded from doing a Roth backdoor Roth.
Yeah.
You can transfer your IRA to your 401k or to a work plan, or if you're self-employed, put it in your qualified plan, your solo K or something. Yeah.
So we're always out here preaching, when you leave a job, roll your 401k into an IRA. That's still true for a lot of reasons. They're expensive. The funds aren't, you don't have a lot of robust options. You can't rebalance, yada, yada, lots of reasons to do this. However, if in some cases, if you're a high earner and you want to do the backdoor Roths, you don't roll it into a rollover IRA, you roll it into your new company 401k, and you just keep doing that. And yes, you're allowed to do this. They want your contributions. Trust me. Yeah. They make money off of you. So they will let you.
Right.
And now you have no IRAs. And you can go ahead and do the backdoor Roth.
That's right. And we have clients, sometimes we tell them like, hey, you got this big IRA with us, put this in your 401k at work, and then we can do these Roths. And why would you tell us to do that? You're hurting yourself. You're managing our money. You're not going to have that money to manage. William, this is our friend William. We work for you. We're not working for ourselves here. We're trying to help you, maximize your weelth and your future. Yeah. So this is not about us.
It'll be repaid in spades someday. Whatever.
It's sad that they would actually think that we are looking out for ourselves above them.
Because not all advisors are held to the fiduciary standard.
Right.
So you should ask your advisor, are you a fiduciary? If they tell you not to roll your IRA into a 401k, your next question should be, are you a fiduciary?
Yeah. If they are, why are you putting yourself above somebody else? Right.
Okay. So again, all these Roth conversion things, they have to be done by the end of the year. Now, if you're lower income and you want to do a direct Roth, you could do that until the day you file your taxes.
Yeah. No problem. All right. Here's a little quickie, but this will actually help you with your girlfriend, Irma, who you're trying to break up with. You can make your January mortgage payment before 12/31 and get that interest that you pay that's in that mortgage payment into this year's interest. Most people know that. But it's a good,
does it? I have to log in and change my payment date.
Yeah, what a pain. You're going to pay it on, January 1st or something instead. Pay it now. You get the deduction this year. It'll save you, it could save you $1,000 of tax again. Yeah. So
especially if you're going to do charitables and you want to itemize and you need a couple dollars more in your itemized.
But you know what? I correct that. It's not going to help Irma because it's an itemized deduction.
Oh, you're right.
We
misspoke.
Below the line. So sorry. Correct that. Let me reverse that.
You're right. It doesn't help with Irma, but it helps with the amount of taxes that you pay.
It'll definitely save you tax for sure. Yeah.
Okay, let's talk about electric vehicles.
Let's do.
If you've been in Marin County in the last 2 months, you have definitely seen a Rivian driving around. They are everywhere all of a sudden. They're fully electric and they're cool. So don't forget about tax credits for buying electric vehicles. If you've been thinking about one, just go get it by the end of the year. They have the year-end sales and stuff anyway. So I'm going to read some numbers here. Many new EVs qualify for a credit of up to $7,500.
Wow.
And it's $4,000 if you buy a used EV. I will tell you, one year I bought my electric hybrid was 2021. It saved my booty on the taxes because it's a direct credit on your taxes.
Yeah.
So it's good to know that there's a cost limit on the vehicle itself. So if you're doing a big vehicle like an SUV, it's $80,000. If it costs more than that, then you do not get the tax credit. Same, of course, if you have high income, you don't get to participate in this, of course. And that is $300,000 Maggie for a married couple. You don't get that.
Okay.
If you wait, there's one more thing on EVs. Good thing I have notes. If you wait until 2024, you can opt to monetize the credit by transferring it to the dealer at the time of purchase, thus lowering the amount you pay for the car. This allows you to take immediate advantage of the credit instead of waiting until you file your taxes. Like you're going to buy a car in January, you don't get that credit until April, maybe, of the following year. So you could get it right away.
This stuff is so complicated. I need a financial advisor. Oh, wait a minute. I am one. Okay.
Well, because the next thing I was going to say about this is that sounds like a good deal for a lot of people. But what if you're that client that we have that was $2,000 over the IRMA?
Yeah.
Right. In that case, does that client want a reduction in the price of their car, or does that client want a reduction in their Maggie?
Yeah.
Right.
7,500.
Yes, exactly. So sophisticated people think things like this through before making these decisions. They talk to advisors. They understand how these tiny little things, these little decisions that we make throughout the year can make or break them. And I'll tell you, if you're working with an advisor, you're just getting one up on everyone else because they don't know this.
Yeah. So. And you're certainly getting one up on the IRS.
Oh yeah.
Which they probably don't like, but that's too bad.
They're not watching.
Code. We see so many examples of this as an aside where people make a lot of, they're just dumb mistakes that they don't know because of ignorance. And they make, we didn't know. We applied for our Social Security like 3 years early because we thought it was a good idea. They might run out. It's just,
lest you think we're judging people who don't know. I blame this on both our education system. There's no class in high school or college on like personal finance. Teach me how to file my taxes, not, the quadratic equation. Like I'm not using that.
Yeah. I've never used it the rest of my life.
Actually, we use it a lot, but we do it in Excel.
Yeah, right.
So who cares?
Yeah, right.
And what was the other thing? It's gone.
Oh, it was about the lady who sold an apartment building like a year before she died for $600,000 and had $400,000 of capital gain. And she could have just waited until she died. And she was advised by her daughter and her son.
Yeah.
They just didn't know.
Yeah.
And they had this gigantic tax. And it was like, why didn't you talk to us before you did this?
Right.
We would have advised you. So, but it's just, these are just the things that happen in this world, people just aren't aware of. All right. So if you're considering home upgrades, getting back to tax savings, go green to claim one of two tax credits. The first one is a residential clean energy property credit. And this is for things like people who install solar panels, solar powered water heaters, batteries for their home, and things like that. The credit is 30% of everything you spend, all the materials and all the labor. So if you want, you still have time to get that going. You can actually get in a contract and you can pay it in 2023 and have that. I think you got to have it put in place in service before the end of the year.
We'll put it in the show notes for you.
Won't work. The smaller energy tax credit is called the Energy Efficient Home Improvement Credit. And that applies to things like insulation, central air conditioning, water heaters, water pumps, exterior doors, windows, and the like that meet certain energy efficiency criteria ratings. This tax credit is also 30%, but it's capped at $1,200 a year. So that means that you probably would have to, if you're going to spend more than that, you have to spread it over a couple of years. to maximize. Why would you spend it all right now when you can do
let's say you're
half
like
today and half-
remodeling your kitchen right now and you're about to buy appliances, buy a few today, wait 3 weeks and then buy a few.
Exactly. Save $1,200 in tax, right? Yeah, exactly.
Sometimes with
Come on, snap out of it. Let me snap you. Let me slap you.
That's right? As the kids would say, that's our vibe today. Come on. Okay, so this is a fun one. If you have a vacation home, like a second home, or maybe you're leaving your home for the holidays, like to heck with it, we're going on a 2-week cruise. You can rent out your home on the short-term basis and potentially not pay any taxes on that income. Here's how it works. If you do it for less than 2 weeks in any calendar year, there is no reporting, no taxes. No one even knows you did it. Okay. Now imagine this. You have a house in Tahoe and it's Christmas. You could potentially be renting that house out for $500 a night up there.
Easy.
You pocket all that. You're not even there. Pocket the money.
Yeah.
You don't have to report on your taxes. You don't have to do anything. I mean, there's the minor or major in some cases, pain in the butt factor of renting a house, right? I mean, I obviously use a property manager, but you can do this and it could make a lot of money. I have a friend that lives in Scottsdale and there's this like PGA tour. Apparently people rent homes for like $10,000 a night during this tour. I mean, go on a vacation, rent your home out and you don't pay any taxes on that. That's gonna be a lot of money.
Tax-free.
Yes.
Tax-free. Or if your kids come to visit you for Christmas, you can charge them rent and it's tax-free.
Okay, are you listening, Del Monte kids? Apparently this is happening.
That's right. Poker's going up, kids. Okay. So the next one is making the most of your generosity when donating to charitable organizations. This is where we are actually, instead of donating cash to your charities, your favorite charities, donate appreciated securities. So you look in your portfolio at your Schwab account or whatever, wherever you have your accounts. And if you have the things that are most highly appreciated that are in your taxable account, not your IRA, you can just donate those shares directly to the charity. And you get a full deduction for the fair market value of that security on the day you made the donation. The capital gain that you've made on that period of time, on that stock, is just poof, it goes away. Amazing. The caveat is you have to have held it for a year and a day, the stock, or the mutual fund or whatever. So because it has to be long-term, right, in nature. But that is a huge one. And then just if you want to own the stock still, buy it back with the cash you would have given to the charity. Now you got the same security at a stepped up cost basis. Bingo.
Because what a lot of people do too is they sell the security, they pay the capital gain tax, and then they give the money to the charity. Instead, we can band together to really screw over the IRS because a charity, as a charity, does not pay tax on capital gains.
Yeah. We have a Facebook page for screwing the IRS, just so you know. No, we really don't.
Leave us alone.
Yeah, right. Yeah, we'll be on the audit list next.
Okay, so speaking of gifting, if you like to give money to private persons, use your annual gift tax exclusion. So this is 2023. Each person can give another person $17,000 per year. This is use or lose. So that means a married couple could give $34,000 to each of their children or any one of their choosing. Just kidding. I make good money. We're fine. Okay, So you don't have to pay any gift tax. You don't have to include this in your tax return. It does not count towards your lifetime exemption. And if you don't do it, like I said, you lose it. So do it. And recipients aren't taxed on these gifts.
Yep.
Oh, let me say one more thing about that, actually. Let's tie two things together. Instead of giving your kids cash, give them the appreciated securities if they're in a lower tax bracket than you.
Oh, yeah, for sure. They could sell it and pay no tax. Speaking of which, we're going to talk about that right now.
Yes.
So you can actually qualify. Some people can qualify for a 0% tax rate on long-term capital gain income and on qualified dividends. How, you say?
Tell me.
Well, there really is a 0% capital gain tax rate, believe it or not. So if your taxable income, other than long-term capital gains and dividends, doesn't exceed $44,625 if you're single, or $89,250 if you're married filing jointly, then your qualified dividends and profits on sales of assets owned more than a year are taxed at 0% until they push you over a threshold of about 118,000. So that's about 30 or 40,000 of income that you can realize and not pay any tax on it. Okay. So I mean, you should do it if you can. There's not knowing about it just means that opportunity goes away. And at some point you're going to pay tax when you sell the asset.
Yeah.
So you want to be aware of these things so you can actually do those things now, realize the income, pay no tax, and move forward.
And this isn't just for people whose income is always under that threshold. There are a lot of times when higher earners will have a year of low earnings in the year they retire, or maybe not in America, but in the year you have a baby. The same you might take. So you have a disability or whatever. Your income's lower for some reason. You might go to your Schwab account, scroll your portfolio, and use up that capital gain exemption.
Absolutely. So again, you got to be aware of these things. You've got to track your income. You've got to know your tax brackets. You got to know Irma and Maggie, all these broads. You got to know them all so you know what to do.
And you have to do it without any education on the topic, which is why we're here.
Right.
Oh man, this is kind of a long list this year, but there is a lot that you can do. And we thought it was really important to share it all with you.
Yep.
We hope that you found some tips. We hope you have enough time to get it done. We are here if you want some help with that. This is going to be our last episode of 2023. We thought we'd wrap it up with all the end of the year stuff. We just really want to thank you for coming on this journey with us, for continuing to watch and listen wherever you are. We're going to try to enjoy some time. I'm not going to try. We're going to enjoy some time with our families this month. And also, we're going to be working with our clients on implementing, all of these things. We get really, really busy in December. So we hope that you have an amazing holiday season with your loved ones. We're wishing you all of the health and happiness in the new year, and we will definitely see you then.
Yep.
Yeah.
That's right.
As always, like and subscribe wherever you're listening so that you don't miss a show when we come back. If you would like to write to us, please do so at info@aplaceofpossibility. If you have questions or, you have a topic idea, we're always looking for those. We want to know what you want to hear. Also, if you'd like to schedule a meeting to discuss anything we talked about today or your general finances, I suggest you click the link ASAP because, like I said, we get really busy in December. So there's not going to be a lot of meetings.
We still want to talk to you.
Definitely. We'll make time. We'll figure it out.
Yeah.
Finally, if you haven't gotten your copy of the investment answer yet, we'll send you one for free. This is a primer on how we manage portfolios, and it's really easy to read. It won't sound Greek at all, but it gives you some insights into the investment philosophy that we use here. Yep. Can you take us home?
Okay. Thanks a lot for being with us today on this episode of A Place of Possibility. We look forward to seeing you again next year. Remember, until then, you're invested and so are we.